Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. Inflation is the biggest worry for the global markets right now, which has led to monetary tightening from the central banks everywhere. Inflation in most countries is breaking all records and reaching historically high levels. So, for an investor, what does it mean when inflation is shattering all past records? Should you stay invested or pull out? Or if you invest, what should you be careful about? In today's video, let's look at what super investors such as Warren Buffett, Charlie Munger, Howard Marks, Seth Klarman, Lee Lu, Terry Smith have to say about the impact of inflation on investing and what they advise to do in terms of high inflation. This is part 2 of multi-part series on investing during inflation. In this part, we will cover the advice from Seth Klarman and Terry Smith. Before we start, smash that like button so others can find this video as well, and do subscribe to get the next videos in this series. Let's dive in. First, let's start with Seth Klarman, the value investing guru that many follow. 2 key pieces of advice from Mr. Klarman on inflation are: first, in his latest letter to investors, he mentions that we don't know how bad the current bout of inflation will be, but we believe that mounting inflation and the related possibility of materially higher interest rates are posing a real danger to financial markets. So, according to him, it's not really clear on how bad the inflation situation actually is and what it will take to bring it under control. He further shares that against a backdrop of relentless money printing, a very active Federal Reserve, many investors have been lulled to sleep, unaware of and unfocused on risks. According to Mr. Klarman, to protect against continuing inflation and the prospect of rising rates, we have purchased hedges that stand to gain in such an environment. Second, in terms of where to invest during an inflationary period, according to Mr. Klarman, in reality, no one knows what the market will do. Trying to predict it is a waste of time, and investing based upon that prediction is a speculative undertaking. So, he suggests buying and holding the best companies in the most attractive sectors is a more logical approach compared to seeking to predict the future. This can involve purchasing stocks that have solid financial positions so they can survive on economic downturn. They may even be able to improve their competitive positions at the expense of weaker rivals during a period of tough operating conditions so that they can take advantage of a subsequent recovery. Similarly, it could mean buying companies with the obvious economic moats. For instance, companies with strong brands, unique products, or that enjoy lower levels of costs versus rivals could hold significant appeal. Now let's look at what Terry Smith, another value investing guru and founder of Fundsmith, has to say about investing during high inflation. 2 key pieces of advice from Mr. Smith are: first, in his half-year update letter to investors, Mr. Smith shared that the cause of the downturn in global equity markets is obvious: the upsurge in inflation and the consequent need to raise interest rates and risk a recession. He further states that I have no insight into how severe or persistent the rise in interest rates will need to be to quell inflation, but I am not optimistic. Interest rates as a tool to combat inflation are a blunt instrument at the best of times, and I suspect more so in this instance when the inflation has not been caused by demand exceeding supply during an economic boom. Second, Mr. Smith also discusses the impact of inflation on equities by sharing that inflation, rising interest rates, and an increasingly likely recession have 2 obvious effects on equity investments: fundamental effects and valuation effects. He discusses these effects and connects it to the performance of some of his holdings. Inflation causes an increase in the cost of ingredients, components, and other inputs which constitute companies' cost of goods sold. The best defense against this inflation is a high gross margin, the difference between sales revenue and COGS. He shares that on average, last year, the companies in his portfolio had a gross margin of 60% compared with about 40% for the average large listed companies. Also, he shared that 10% rise in COGS clearly has much less effect on the profitability of companies in his portfolio than average. It is clear that the high and sustainable gross profit margins of our companies provide a robust line of defense. On the contrary, the combination of low gross margins and high fixed costs is dangerous, and Mr. Smith suggests avoiding such companies, for example, Target and Walmart, during inflationary periods. That's it from us for now. Hope you enjoy listening to the advice from super investors. Please smash that like button and be sure to subscribe to get the next videos in this series on investing during inflation. Thanks for watching, and we'll see you in the next video.